Hello, this is Dr. Karen Nunez. Welcome to the Chapter 9 lecture. In Chapter 9, we're focusing on long-term assets, both the fixed assets and the intangible assets. Let's start with the fixed assets. So fixed assets, the characteristics of the fixed assets are that they're relatively permanent, and they typically are related to things like the plant and equipment. Plant, property, and equipment. And sometimes we just abbreviate those fixed assets as PP&E, again, for plant, property, and equipment. Now, more specifically, fixed assets, they have a physical existence. You know, they're very tangible. You can see them, you can touch them. They are owned and used in normal operations. So they're not assets that are purchased for resale. They are assets that are purchased and used in the normal operations. That means that they're used to generate profits. They're not offered for sale. They are a part of the normal operations. Normal operations meaning whatever they're in business for. If they are providing services or providing product, those assets are used to provide the services or to provide the product. The assets are not being sold for a profit. They're being used to help generate profits. And those fixed assets are critical to the success of the business. So the thing that we have to focus on in this chapter is over time, fixed assets, with the exception of land, they tend to lose their ability to provide services. That means that you buy something early in its life. For example, something like an automobile. When you buy it, that's when it is at its maximum ability to provide services. But as you use that vehicle, that automobile over time, then what happens is it starts to decline and it starts to lose its ability to provide the services that you need. And so the costs of these fixed assets, the equipment and the buildings, what we have to do is we have to recognize that we have use of those assets for a specific useful life. And therefore, what we attempt to do is apply the matching principle. This is a principle that we talked about a few chapters ago. And that means that what we attempt to do is to assign a portion of the cost of the fixed asset to an expense account over its useful life. That process is called depreciation. Now, land is the only fixed asset that we do not depreciate because land has an unlimited life, unlike equipment or buildings or other property, which has a measurable limited life. Land has an unlimited life, an immeasurable life, and so that is the only fixed asset that we do not depreciate. When we depreciate these fixed assets, there are three factors that we take into consideration to determine the depreciation. One is the initial cost of the asset, two is the expected useful life, and three is the residual value, if any. The residual value is just what we expect to recover at the end of its life. So the initial cost is probably self-explanatory. It's what you pay for it. It's what it costs to bring the asset in-house and to make it ready for its use. And then the expected life, again, that's kind of obvious. That's the period of time that you estimate you're going to have use of the asset. So these factors, when we put all these factors together, uh, again, the cost of the asset, the useful life, and then the residual value. We put these variables together, and it helps us to determine the depreciation expense. Also, when we combine two of those key factors, which is the cost of the asset and its residual value, we end up with what we call the depreciable cost. So the difference between the cost and the residual value, right? The cost and the residual value is that depreciable cost. And it's that amount that we allocate to depreciation expense over the useful life. There are three methods that we use to depreciate these fixed assets, and we'll look at all three in this chapter: the straight line depreciation method, the units of activity depreciation method, and the double declining balance depreciation method. Uh, Consistency is required in determining depreciation. That doesn't mean that you have to pick one method and use that method for all of your fixed assets. It just means whatever method you pick for a particular asset, you have to use it consistently. So, for example, you could use straight line depreciation for equipment. You could use units of activity depreciation for automobiles. You could use double declining balance depreciation for buildings. You just have to pick a method and use it consistently for the related asset. Let's start with the straight line method. So the straight line method provides the same amount of depreciation expense for each year. So straight line, that's kind of an indication of the way the method works. It's a straight amount each year over the life of the asset. So in this case, if we have an asset that cost us $24,000 and it has a residual value of 2,000, again, this, what I'm going to put in brackets here, cost minus the residual value is the depreciable cost. So this depreciable cost spread over the useful life, right? The depreciable cost divided by the useful life gives us the annual depreciation, the annual depreciation expense for each year of the asset's life. So from years 1 through 5, we're going to recognize depreciation expense. Every year, it's a straight amount or a fixed amount of depreciation on this $4,400. And we talked about how to recognize depreciation in I think it was chapter 3 when we looked at adjusting entries. And the way you prepare an adjusting entry for depreciation is always to debit what we call depreciation expense. So it doesn't matter what method you use, the recognition of the expense for depreciation is always a debit to the expense account and a credit to accumulated depreciation, right? And again, it doesn't matter what method you're using, it's always going to look like this. In this case, it's the $4,400 of depreciation expense, debit depreciation expense, and credit accumulated depreciation for the $4,400. So that's what we would do, right? And this entry would look the same every year for the next 5 years. It's 5 years depreciation at $4,400. That's the straight line method. Again, it's a straight line. Every year, we're going to have $4,400 of depreciation. At the end of each year, that's the adjusting entry, debit depreciation expense and credit accumulated depreciation. So essentially, what this works out to is 20% of that depreciable cost is being depreciated each year for the next 5 years, right? If you were to take that 100%, and if you were to divide that 100%, right? Because we're depreciating all of that depreciable cost, right? If we depreciate all of that depreciable cost over its estimated useful life, in this case of 5 years, then what would happen is we would end up depreciating exactly 20% each year. That's our straight line depreciation rate. So the actual amount of depreciation is $4,400 each year, right? And that represents exactly 20% of that depreciable cost. 20% is the annual straight line depreciation rate, 20% or $4,400 each year. Now, we can also easily determine the straight line rate for other expected useful lives. So we just looked at, if it's a 5-year life, that's 20% a year. If it's an 8-year life, 100% divided by 8 is 12.5%. If it's a 10-year life, then it's 10% a year. If it's a 20-year life, it's 5% a year. If it's a 25-year life, it's 4%. The point is that if we want to know what the straight line percentage is, just divide the estimated useful life into 100%. It's always going to be 100%. If we want to know what the straight line rate is, it's always going to be 100% divided by whatever that estimated useful life is. So whatever it is, whether it's 5 years, 8 years, 7 years, 30 years, 50 years, it doesn't matter. Just 100% divided by the estimated useful life gives us the straight line percentage. That's how we're always going to calculate it. So again, when we record this depreciation, that entry is going to look just like this. Debit depreciation expense, 4,400, credit accumulated depreciation, 4,400. That's the adjusting entry to bring the accounts up to date. Let's look at our second method, the units of activity method. The units of activity method is a two-step method. The first step is to find what we call the depreciation per unit. It's kind of a depreciation rate. And what we do is we take that depreciable cost, which is the cost of the asset minus the residual value divided by the total estimated units of activity. That gives us that depreciation per unit. And then the actual depreciation expense, that step two, to determine the depreciation expense, it's the depreciation per unit times the units of activity for the period. Right. So first step, find the depreciation per unit. Second step, find the depreciation expense. Let's look at an example here. Well, I'm sorry, I thought I had an example, but I don't. That's a little bit later. We'll see that a little bit later. Let's go on and talk about the double declining balance method. So the double declining balance method is a method that provides for what we call a declining rate of depreciation over the estimated useful life. That means every year the depreciation gets smaller and smaller. We start out recognizing more depreciation, and it declines as the age of the asset increases. The double declining balance method is a three-step method. The first step here is to find the straight line percentage. So just like what we looked at before, right? We want to take that 100% and we want to divide by the estimated useful life. So the straight line rate is 100% divided by that estimated useful life. And once we get that straight line percentage, we multiply it times 2, right? So the straight line percentage from step 1, going to multiply times 2. Why? Because the method is double declining balance. So we want to double the straight line rate. So whatever the straight line rate is, we double it or we multiply it times 2. And then to actually calculate the depreciation expense, we're going to take the double declining balance rate from step 2, and we're going to multiply times the book value of the asset. What's the book value? Well, the book value, and I'm going to switch to the calculator mode here. So the book value of an asset, the book value actually equals the cost of the asset minus any accumulated depreciation. So the book value of the asset, again, is the cost minus the accumulated depreciation. And we're going to find the depreciation expense, okay, by taking the DDB rate times the book value of the asset. So here's an example of the DDB rate. So we've got equipment that costs $24,000, and each year the rate of depreciation is going to decline. And we are going to use the straight line rate, of depreciation. So we're going to use the double declining balance rate of depreciation, which is the straight line rate times 2. We're going to double whatever the straight line rate is. So again, in this case, if we've got an asset that has a 5-year life, then the straight line rate, so I'm going to abbreviate here, S/L, the straight line rate is just going to equal 100% divided by the estimated useful life. So in this case, what we're saying is, again, we got 100%, and we're going to divide it by 5 years because it's got a 5-year useful life. So the straight line rate is 20%. And the double declining balance rate, so the DDB rate, is going to equal 2 times the straight line rate, which is going to equal 2 times 20%. Or we got a 40% DDB rate. And Depreciation is calculated by taking the book value at the beginning of the year. First year of the asset's life, the book value is the cost. So the book value is 25,000. Let me switch to the pencil here. So the first year, the book value is 24,000, and we're going to multiply times this DDB rate. 24,000 times 40% gives us the first year's depreciation, which is 9,600. And now, all right, the book value of the asset. So the book value of the asset now is the book value at the end of the year is the book value at the beginning of the year minus the depreciation for the year. So the 24,000 minus the 9,600 gives us our book value at the end of the year, 14,400. And now what we're saying is the depreciation the second year is the book value at the beginning of the year times the DDB rate, 14,400 times 40% gives us our depreciation for the year. And then our new book value, again, is going to be the book value at the beginning of the year minus the depreciation for the year. And we continue in that fashion. We just take the book value at the beginning of the year, multiply times 40%. That's our depreciation each year. And we'll see this again in the homework assignment. So 3 methods of depreciation for the fixed assets: straight line depreciation, the units of activity method, and the DDB, double declining balance method. So the only one we didn't look at is units of activity, but we'll see that in the homework. But I did just go through the straight line method and the double declining balance method. And again, we'll see all 3 in the homework assignment. Next, we also have additional assets to account for over their useful life. So we've talked about the fixed assets that are tangible and used in the operation of the business. We also have natural resources. Some businesses own natural resources like timber and minerals and oil. And the characteristics of these natural resources are just a little bit different. So what differentiates these natural resources is that they have, essentially, they're created through natural growth. So they're not purchased like physical assets, not physical and tangible assets that you purchase and use in the business. Instead, these assets that they grow and they grow naturally. And then we have to actually remove them in order to be able to sell them. And so the assets are essentially consumed by removing them. As we remove them from the land, they become consumed, and the available amount is then reduced as we harvest them from the ground, if you will. So what we have to do is whatever the cost is of these natural resources, we've got to allocate it to an expense account over the useful life of the resource. Just like with depreciation, cost of the asset has to be allocated to depreciation expense. The cost of these natural resources has to be allocated to an expense. We call that expense depletion. So in this case, whenever we have a natural resource, the way that we allocate the cost of the natural resource to an expense account is a 2-step process. And that first step, we find what we call the depletion rate. And it's kind of like the units of activity method, right? We find a depletion rate, which is the cost of the asset divided by the estimated total units of the resource. And once we get that depletion rate, then what we do is we multiply it times the quantity that we've removed. And that gives us our depletion expense. And we would just record an adjusting entry for the depletion, just like we do for depreciation. So in this case, we have a natural resource that cost us $400,000. And what we do is, again, use a 2-step process and find the depletion rate. So the cost of the asset of $400,000 spread over the estimated total units of this resource. 1,000,000 tons is what we expect to harvest from this natural resource. So the depletion rate is 40 cents a ton. And in this first year, we've removed 90,000 tons. So the amount of depletion that we're going to recognize is $36,000. And in an adjusting entry, that's exactly what we do. Debit depletion expense, credit accumulated depletion. just like with depreciation, only we call it depletion. So debit the expense, credit the accumulated account, and we would do that every year for the amount that needs to be recognized. And accumulated depletion is a contra asset account, just like accumulated depreciation. So it offsets the natural resource that it is related to. Next, in addition to these fixed assets and the natural resources, we have another kind of long-term asset that we have to systematically allocate its cost to an expense account over its useful life. They're called intangible assets. These intangible assets are used in the business, just like fixed assets and natural resources. But these intangible assets, they don't exist physically. They have no physical substance. They are intangible in nature, and they typically are acquired through innovative and creative activities, or from just purchasing the rights from another company. The problems that we face, the accounting issues, if you will, that we face in accounting for these intangible assets is we need to be able to determine the initial cost, and we've got to make sure that we can amortize the cost of that asset over its useful life. So the fixed assets we depreciate, the natural resources we deplete, and the intangible assets we amortize over the passage of time. So an example of an intangible asset is a patent. You know, a patent gives you an exclusive right. It gives you an exclusive right to produce or sell goods that might have unique features, and you have to actually file, the patent with the U.S. government, and then you receive the right to you have exclusive rights to produce and sell that product. So, for example, if there are certain products, when you invent the product, you apply for the patent. And then once you receive the patent, you have the exclusive rights to that product. No one else can come in and produce and sell your product. You have the exclusive right to that product. And these rights generally are effective for 20 years. And if you purchase the rights from someone else, then you have whatever the remaining life is on the patent. And our obligation for patents is to amortize the cost of the patent over its remaining expected useful life. And we typically will use a method that is a lot like straight line depreciation. The amortization of a patent or the amortization of any intangible asset is typically straight lined over its useful life. Whatever the life is, the remaining life is, we would amortize it. So, for example, in this case, we have a company that acquires a patent for $100,000, and the patent is not expected to expire for 14 years. But what we believe is that we're only going to receive benefits over another 5 years. So typically what that means is, 5 years down the road, someone's going to come out with a new product that will supersede your product, and your product will no longer have value. So you really are only going to receive benefits from the patent for 5 years. So the amortization needs to be over just the remaining life of 5 years, not the entire useful life of 14 years, because you're not going to get anything over the entire 14-year period. You're only going to receive benefits over 5 years. So that's the amortization period. So we're going to take that $100,000 and spread it over 5 years. That's straight line amortization, which means $20,000 goes to the expense account, amortization expense. And the other $20,000, we don't typically, companies don't use, accumulated amortization. Typically, the amortization goes directly into the asset account. So it would be patent amortization, for example. We wouldn't be crediting an accumulated amortization account. And other examples of intangible assets, typical examples would be copyrights and trademarks. So, a copyright gives you, again, an exclusive right. In this case, it's an exclusive right to publish and sell literary, artistic, or musical compositions. A trademark, is an exclusive right to a name or a term or a symbol. So a good example of a trademark is something like the Nike swoosh. That's something that Nike has an exclusive right to. And typically, these rights extend for a given period of time. And so, what we have to do is we have to spread the cost over whatever the estimated remaining useful life is over the period of time that we believe we're going to receive benefits. And the amortization is always straight lined for these intangible assets. The only exception is what we call goodwill. A goodwill is an intangible asset. And what goodwill relates to, I mean, technically, what goodwill is the excess purchase price paid. So, for example, if company A buys company B and they pay an amount that exceeds the value of the company. So, say for example, they pay $1 million for something that only has assets of $500,000. Well, why would you pay $1 million for something that has assets of only $500,000? You could sell those assets for $500,000. Why would you spend $1 million on those assets? Well, the reason why you would do that is because you're buying something other than just physical assets. You're buying a superior sales force, or you're buying a superior customer network. You're buying something that creates value. So you might be buying, a key location, or you might be buying product that has high quality that you can't get anywhere else, or you might be buying reputation, or maybe you're buying managerial skill. You are buying something that exceeds the value of the assets. And we call that goodwill. Goodwill obviously is intangible. It's not physical. It doesn't have physical substance. You can't touch it. You can't see it. You can't feel it. But it's there. You know it's there because it's been valued as such. But what GAP says is we can't amortize goodwill because it's very difficult to determine what the estimated useful life is for goodwill. So essentially what GAP says is unlike, patents and copyrights and trademarks, what we should do with goodwill is if we determine that there's some kind of a decline in the value, if there's a potential loss that we can determine, then we would only recognize that. So that's all we do with goodwill is if there's a loss, then we would recognize it. And the only way to determine that is to have a, professional company come in and try to determine the value of your goodwill and compare that to whatever it is you have recorded on your books. And if there's a difference, well, then we would recognize it as a loss. So it's not an expense account. We just call it a loss account. Debit the loss, credit the goodwill account. So it's kind of like amortization in that we're amortizing a portion of the cost. It's just that a portion of that cost goes into a loss account. It doesn't technically go into an amortization account. So to summarize these intangible assets, so patents and copyrights and trademarks, those are all going to be amortized, right? We're gonna amortize. I'm sorry, patents and copyrights. The current gap is to amortize those over their useful life. You can't exceed the legal life. You have to choose whatever the useful life is. But trademarks, currently, we cannot amortize. We would only recognize if there's a loss, just like with goodwill. So it used to be that patents and copyrights and trademarks were all amortized. Now we can no longer do that. These two, trademarks and goodwill, we can only record losses if we can identify that we have a loss. So that brings us to the last thing, reporting these assets in the financial statements. So the three different kinds of assets that we've talked about would all be reported as long-term assets in the balance sheet. So plant, property, and equipment, is where you would typically see those fixed assets. And then if there were any intangible assets, you would have intangible assets like goodwill listed as well. And if you had any natural resources, you would have those listed with your long-term assets as well. And that's it. And again, if there are any accounts that are related, any contra accounts like accumulated depreciation or accumulated depletion, those amounts would offset the related asset, and you would see the net amounts being reported on the balance sheet. So we'll look at a few examples of all of these items that I've talked about in the homework assignment for chapter 9, and I'll see you in the next session for our homework from chapter 9. That's it for our lecture.